Renowned for his best-selling book, Rich Dad, Poor Dad, Robert Kiyosaki is a highly recognized author and influential speaker on personal finance and entrepreneurship. With recent surges in layoffs at major corporations such as Google, Microsoft, Amazon, and Facebook, Kiyosaki has been sounding the alarm for investors, predicting an imminent market crash. Keep watching until the end for Kiyosaki's warning and what steps he recommends you take to secure your financial future. Kiyosaki recently warned his followers that inflation may lead to the Greater Depression and that real estate was crashing. Then in February, he took to Twitter to declare the crash is here. While the onset of a global recession is something nobody wants, it is important to remain calm and patient and make informed financial decisions to weather the storm and secure financial well-being. Here are Kiyosaki's 6 factors posing high economic threat and global recession potential. The first factor: excessive debt. Kiyosaki strongly emphasizes that excessive debt is one of the most significant challenges facing the economy. He argues that both individuals and governments have burdened themselves with an overwhelming amount of debt and created an extremely fragile financial system. When individuals, companies, or governments find it difficult to meet their debt obligations, it can trigger a chain reaction that leads to reduced spending, decreased economic activity, and ultimately, a recession. For instance, if a substantial number of individuals or companies struggle to repay their loans, banks and other financial institutions may suffer significant losses. This can result in a credit crunch, where banks become more cautious about lending money, making it challenging for businesses and individuals to access credit. If this situation becomes widespread across multiple countries, it can contribute to a global economic recession, similar to the events of the 2008 financial crisis. On a personal level, Kiyosaki advises people to actively reduce their debt levels and build up their cash reserves. He firmly believes that having cash on hand enables individuals to seize opportunities that arise during a market crash. By being financially prepared and having the ability to act when others are financially constrained, individuals can potentially benefit from the situation and navigate economic downturns more effectively. The second factor: inflation. Inflation refers to a sustained increase in the general price of goods and services within an economy over time. According to Kiyosaki, the current policies implemented by central banks, such as low interest rates and quantitative easing, are contributing to higher inflation. This, in turn, has the potential to erode the value of people's savings and investments, reduce investment activity, and lead to higher interest rates. Moreover, inflation can introduce uncertainty and instability in financial markets, ultimately contributing to a recessionary environment. The third factor: economic inequalities. Economic imbalances can arise when there is an unequal distribution of resources or wealth within an economy, leading to instability and insecurity for certain groups. Kiyosaki argues that the current economic system often favors the wealthy, which ultimately results in social and economic instability. When wealth is concentrated in the hands of a few, it can lead to a decrease in consumer spending as the majority of people have less disposable income. This reduction in demand for goods and services can subsequently lead to lower profits for businesses and eventually contribute to a recessionary environment. Income inequality can also hinder social mobility, as individuals in lower income brackets have limited access to education and opportunities for advancement. As a result, economic imbalances can significantly impact productivity and innovation in the long run, thereby negatively impacting the global economy. The fourth factor: external shocks. External shocks are unexpected events such as pandemics, natural disasters, geopolitical events, or other sudden changes that disrupt supply chains and impact the economy. For instance, the COVID-19 pandemic, which emerged in early 2020, has had a profound and lasting impact on the global economy. Many countries implemented lockdown measures to contain the virus, resulting in business closures, reduced consumer spending, and a surge in unemployment rates. The pandemic certainly disrupted global supply chains, with international travel restrictions severely affecting the tourism industry. It also exposed pre-existing economic inequalities and weaknesses in healthcare systems worldwide. Although many countries have since lifted these measures, the global economy has yet to fully recover from the economic repercussions of the pandemic. The fifth factor: policy failures. Poorly designed economic policies, corruption, or ineffective implementation of policies can be significant contributors to economic problems. Policy failures can occur at various levels of government, ranging from local and national to international. These failures can manifest in various forms, including inadequate regulation of financial markets, fiscal mismanagement, ineffective trade policies, or insufficient investment in infrastructure and education. Addressing policy failures is crucial for fostering a stable and thriving economy. Implementing effective regulations, promoting sound fiscal management, improving trade policies, and investing in critical areas like infrastructure and education can help mitigate these risks and create a more resilient and sustainable economic environment. The sixth factor, lack of adequate financial literacy. Kiyosaki strongly believes that many individuals struggle financially due to a lack of basic financial education. He emphasizes that financial literacy is crucial as it empowers individuals to make informed decisions regarding their money, investments, and savings. Kiyosaki argues that personal finance should be included more broadly within the education system. Without financial literacy, systemic economic issues are certain to arise. For instance, if a significant portion of the population is burdened with debt and unable to repay their loans, it can have a ripple effect on banks, financial institutions, and the overall economy. To mitigate these challenges, Kiyosaki advocates for the promotion of financial education at all levels, empowering individuals to make wise financial choices, manage their debts effectively, and navigate the complexities of the financial landscape with confidence. While it's challenging to predict when a market crash will happen, it's crucial to grasp its potential impact on your finances and take proactive measures to safeguard yourself. Since financial preparation and protection against economic crises requires a mix of practical actions and a long-term perspective, the following 4 recommendations from Kiyosaki to help you prepare for market crashes or economic downturns, and hopefully will help you to become better prepared for such circumstances. 1. The first strategy is to establish an emergency fund. Kiyosaki advises having a cash reserve that can cover at least 6 months' worth of living expenses. This fund acts as a safety net in case of job loss or other financial hardships. It's essential to develop a plan outlining the steps you would take in the event of a financial crisis. This plan may involve reducing expenses, exploring alternative sources of income, and downsizing if necessary. Building an emergency fund will help you prepare for an economic recession. It provides a financial cushion, alleviates stress, enables you to seize opportunities, and helps you avoid falling into debt. 2. The second strategy is to diversify your investments. Kiyosaki suggests spreading your investments across various asset classes, including stocks, bonds, real estate, and commodities. This approach helps to reduce the risk of being heavily impacted by a single sector during an economic downturn. Kiyosaki also emphasizes investing in assets that generate passive cash flow, such as rental properties or dividend-paying stocks. These types of investments can provide a steady income stream, even in the event of an economic crash. By diversifying your investments and focusing on assets that generate ongoing cash flow, you can create a more resilient portfolio that is better positioned to weather market volatility. 3. The third strategy is to prioritize financial literacy. Kiyosaki emphasizes the significance of financial education, particularly in investing and entrepreneurship. By increasing your knowledge of money management and income generation, you will be better equipped to navigate the ups and downs of the economy. To stay well-informed, stay up to date with economic news and trends. Seek out reputable sources of information, or consider getting professional advice, such as consulting a financial advisor. These experts can provide informed opinions on protecting your investments and preparing for economic downturns. 4. The fourth strategy is to be prepared to seize available opportunities. Kiyosaki advises being ready to take advantage of investment opportunities that may arise during an economic downturn. This readiness involves having both cash reserves and the knowledge and skills necessary to make informed investment decisions. Kiyosaki's approach is all about being proactive and prepared, rather than being reactive to economic events as they unfold. By building your financial resilience and staying informed about economic trends, you can shield yourself from the negative impacts of economic crashes. It also ensures you are well positioned to capitalize on opportunities that arise during economic downturns, potentially benefiting your financial situation in the long run. Kiyosaki's warning serves as a crucial reminder that market crashes are a reality and can occur unexpectedly. By investing in tangible assets, reducing debt, and building up cash reserves, everyone can take steps to protect themselves from the negative impacts of a market crash. I will keep making these videos to help you achieve your financial goals. Subscribe to my channel so you don't miss out. See you soon.